Welcome to week 3. Listen carefully. I'd like to talk to you about the world of fixed income securities. Go out and buy a bond. You are a general creditor. The issuer of that bond may be the U.S. government, a municipality, or a corporation. In which case we're dealing with corporate bonds, municipal bonds, or government bonds and government securities. And in buying that bond, I want you to know that the issuer is raising capital with debt financing. Debt financing means borrowed money. In effect, taking out a loan from bondholders because they are required to pay you back not only Series 7 Bullet 1, the interest that's built into that bond, known as 7, the nominal yield. The word yield means return. Break that language right now. But also at the maturity of the security, the repayment of the principal amount of the bond. Now, the repayment of the principal amount of the bond is also known as the repayment of what is called par value. Par value also means face value. What is face value? It is the amount of money that the bondholder receives and gets repaid at the security's maturity. For corporate bonds and municipal bonds, par value or face value for one bond is equal to $1,000 per bond. So when I ask you for the price of what is known as face or par, you would say $1,000. Now, that is completely independent of the client's cost basis. That means that a client can go out and buy a bond for $2,000, knowing that at the point of purchase, he's only going to get repaid on the principal side, par value, which is $1,000 at the security's maturity. And so the question now becomes, why would any bondholder go out and buy a bond for $2,000, $1,800, $1,750, knowing that he's only going to get repaid face value, which is $1,000 per bond at the security's maturity? Can anybody answer that question? High yields. Right. Won't you spend more money in capital today to earn more money in interest income? And so therefore those bonds are priced at what is called a premium price because you're going to receive more money in interest income. Well, that should also mean then competitively that bonds that pay lower interest should also be priced at a lower level. Are you with me so far? Yes. In which case those bonds would be known as a discounted bond. Are you with me so far? Yes. So you'll pay more to earn more in interest income, and you'll pay less to earn less money in interest income. So let's get back to the issue as debt obligation to the bondholder. In that, every year you are required as a bondholder to receive and get paid interest income. Are you with me so far? Yes. The interest rate that's built into the bond Series 7 Bullet 2 is fixed. It is not going to change. That interest rate, that interest income that the bondholder receives, again, is known as the nominal yield. Other language for that nominal yield or nominal return, are you with me so far? Yes. For the interest income is known as 7, the coupon rate. When I start talking to you about the coupon rate that's built into the bond or the nominal yield, it means the annual interest income. That interest income is payable to the bondholder every year for 5, 10, 15, or 20 years, depending upon the security's maturity. And then what happens at maturity? The bondholder gets repaid face value, which is $1,000 per bond, and you're out of the investment. So the question now becomes, bondholder buy a bond and lock his money up into the illiquidity of the bond's maturity because you don't have access to your capital. You been so far? Yes. That doesn't mean that a bondholder couldn't put a sell order in with you, the financial advisor, to break the bond's maturity for liquidity needs and sell that bond out there in the secondary market. Are you with me so far? Yes. Could do that. Significant risks when you do something like that, and I'm about to tell you why. Because you could experience possibly a capital loss depending upon where the price of that bond is trading out there in the market. Usually bondholders do not buy bonds to trade bonds like common. Are you with me so far? Yes. They buy bonds for one primary investment objective, and don't forget it. To lock your money up into the illiquidity of the security's maturity for one primary investment objective. 7, the guaranteed interest income that bondholder will receive. He's looking for the revenue stream of fixed interest income. So when the client says, I have $750 to go, and he's more likely to take $750,000 or $500,000 for you to build a bond position for him than he is into possibly the potential capital risks associated with common stock investments when he knows that his principal is protected at maturity, and he's getting interest income. Are you with me so far? Yes. You will build a bond portfolio for that interest income that complements his equity positions, that complements his margin transactions, that complements his derivative trading activity, that complements his retirement portfolio. Can't you see what's really going on here? For all of these products, this is a full-service menu that you will build as a full-service financial advisor. Are you with me so far? Yes. So, we talk about the debt obligation that the issuer has to the bondholder. This repayment of interest and principal to the bondholder built into the bond by the issuer to the bondholder is known as debt service. Don't forget this language. It's very powerful. What is debt service? The issuer has a debt obligation to service its bondholders and repay you interest built into the bond known as the coupon rate. Are you with me so far?
Yes.
Every year. And then at maturity, the repayment of face value. Are you with me so far?
Yes.
Let's get back to this interest income, which is the reason why we buy bonds. Are you with me so far?
Yes.
The most important yield that's built into any bond is the nominal yield or the coupon rate. You're buying bonds for guaranteed and fixed interest income. With me so far?
Yes.
Now, we said that interest income that the bondholder receives is getting paid that interest income annually. Am I right?
Yes.
It's not really 100% true. First, that interest income distribution that the bondholder receives every year, which is fixed, are you with me so far,
yes,
is actually paid semi-annually in 6 months from the maturity's month and day. Now, what does that mean? Well, it means this. Client goes out and buys a bond with a 7% coupon rate or a 7% nominal yield. Now, I want you to take a look at the benchmark that we use from which to tie and pay that interest income to the bondholder. And that benchmark is face value, known as par, which is $1,000 per bond. Are you with me so far?
Yes.
If you take the interest income that's built into the bond and multiply it times par value, which is the benchmark that we use from which to tie and pay the annual interest income to the bondholder, that's going to give us $70 a year in that annual interest income. Are you with me so far?
Yes.
The client bought this bond with a maturity of 12/1/2012. He's going to lock his money up until the year of 2012. Are you with me so far?
Yes.
The bond has a 7% coupon rate built into the bond. 7% times par is the annual interest income distribution of $70 a year. He's not going to get one check for $70. The $70 annual interest income is actually paid semi-annually, 6 months from the maturity's month and day. That's what I just said. So what's 6 months from this maturity's month and day? 12/1 is June 1. June 1, the client's going to get his first semi-annual interest income payment of $35. And what's 6 months from June 1? 12/1. He's going to get his second and last semi-annual interest income payment of $35 to receive his $70 of annual interest income. So the interest income distribution is actually paid semi-annually in 2 installments every 6 months from the maturity's month and day. This $35 every June 1 and $35 every December 1 will go on all the way up until the year of 2012. And in the year of 2012, the bond is matured. He gets repaid face value, which is $1,000 per bond, and he's out of the investment. Are you with me on the structure of the security? Are you with me so far?
Yes.
So, par value now has become the benchmark from which we use to tie and pay the annual interest income to the bondholder. Go out and buy a bond with a 6% coupon rate or nominal yield. Multiply it times face, which is the benchmark that we use from which to tie and pay the interest income semi-annually, and that's $60 a year in annual interest income. A 9% coupon rate, 9% times par, is $90 a year in annual interest income. Are you with me so far?
Yes.
So, the most important yield is the nominal yield. The annual interest income paid semi-annually based on and tied to face value over the life of the bond every year until maturity. Are you with me so far?
Yes.
But every bond you buy also has another yield built into that bond. The word yield means return. It has what is called a current yield. Now, the current yield is completely different than the nominal yield. The current yield or current return means the return on the client's current, listen to me, cost basis. He says, listen, how much is that bond going to cost me that you're recommending to me today? $980, $1,750, $2,300. He says, if I give you $980, $1,750, or $2,300 in capital, are you with me so far?
Yeah.
What would my current return be on my capital investment? This yield is completely different than the nominal yield. The nominal yield is interest income. Are you with me so far?
Yes.
The current yield is the return of the client's cost basis. Currently, for today and for today only, return on capital. Are you with me so far?
Yes.
Based upon however much he's investing to buy that bond and go long his capital investment. And the client says, listen, okay, $980, 4% coupon rate? Okay, how long is the maturity of this bond? How long do I have to lock up my money? 5 years. He said, listen, if I give you $980, earning 4% interest. Are you with me so far?
Yes.
And I lock up my money for the full 5 years. I forget about the investment. Are you with me so far?
Yes.
At the end of year 5, when the bond matures, what would my overall return be on my bond investment? You know, percentage-wise. What he's asking for is the yield or the return to the maturity of the security, the YTM. This is a completely different yield as well. This is the client's overall percentage return on his bond investment. And therefore, what does the yield to maturity reflect? It's the client's overall percentage return on the bond investment. In order to realize and earn a yield to maturity, you've got to hold the bond for the full maturity. Am I right?
Yes.
And the YTM, the client's overall percentage return on his bond investment at maturity, reflects all of the financial returns that are going on to the bondholder. What are the financial returns that I'm really qualifying that is going on to the bondholder? Interest every year for 5 years and the repayment of the principal at maturity. Are you with me so far?
Yes.
Okay, so let's take a look now at a breakdown of a YTM analysis. Are you with me so far?
Yes.
Bonds can be priced, and we're going to talk a little bit more about pricing in a moment, but I already introduced to you 3 different prices. Are you with me so far?
Yes.
We can buy a bond, purchase it, or trade it at face, which means how much? $1,000. The minute I say face, you're talking $1,000. We can buy a bond, trade it, purchase it at any price greater than face. That would be any price above $1,000. That would be called a premium bond. I'm just showing you a $100 premium over par value. Are you with me so far?
Yes.
Any price above $1,000 is a premium bond, and any price less than $1,000 is known as a discounted bond. Are you with me so far?
Yes.
I'm just showing you here, $900, a $100 discount to par. A $100 premium to par. Look up. It seems to be that premium bonds and discounted bonds are based upon whether they are higher or lower than face. Face value, par value, is a much broader concept than you think. What do you know about par already so far? It is the amount of money you get repaid at maturity when the bond matures, regardless of cost basis. Are you with me so far?
Yes.
It also is the benchmark that we use from which to tie and pay the interest income to the bondholder, and it is the benchmark that determines whether other bonds are trading at a premium or at a discount to par. And par is even greater than those concepts as we continue to talk about par value. Well, back to the YTM analysis, getting a little bit more involved with YTM. Because there are only 3 potential bond prices, are you with me so far? Premium bonds, discounted bonds, or par bonds. Then the YTM analysis breaks down to 3 cases because we're dealing with 3 prices. Let's take a look at case 1. Look carefully. Listen carefully today. This is a $1,000 par value bond. It's a par bond. Are you with me so far?
Yes.
The bond has a 10% coupon rate built into the bond. And right there, 10% times $1,000 determines the annual interest income that the bondholder is going to receive, which is how much every year? $100. This bond has a 10-year maturity. The client holds the bond for the full 10 years. Are you with me so far?
Yes.
Take a look at the client's overall yield to maturity. His overall percentage return on his bond investment is 10%. Are you with me so far? If he holds this bond for the full 10 years, he's going to earn an overall 10% return on his bond investment. Now, what's built into the 10% YTM? What's going on the interest income side over 10 years, and what's going on the principal side? Now, what's going on the interest income side? For 10 years in a row, this client, this bondholder is going to receive $100 in annual interest income. Are you with me so far?
Yes.
Now, what's going on the principal side? How much did he pay to go out and go long this bond? Par value. And how much did he get repaid at maturity? Par value. So on the principal side, with respect to par bond purchases, the client really can't make any money. He paid par, and he got repaid par value at maturity. And so the YTM reflects this break-even of principal. Are you with me so far? Paid par, got repaid par, and it also reflects 10 years of $100 a year in annual interest income that would give him an overall 10% return on his money. Take a look at what's happening. Look at the YTM differently now. What's built into the YTM is what's happening to the bondholder on the principal side and what's happening to the bondholder on the interest income side. Here, it's a break-even of principal plus 10 $100 annual interest income distributions for 10 years in a row. You with me so far?
Yes. Which
represents an overall 10% return on his investment. Take a look at case 2. The yield to maturity of a discounted bond is the highest yield of any bond. Why? Because the cheaper the price you pay for the bond today, the higher your overall yield to maturity will be when the bond matures. Why? If you go out and buy this bond, look at me carefully, for $600. This is what is called a $400 secondary market discount. Are you with me so far? You bought that bond for $600. Are you with me so far?
Yes.
What do you get repaid at maturity? Face. How much money did you make on the principal side? $600. You bought the bond for $400. Are you with me so far? You got repaid face value. On the principal side, that bond has Series 7 appreciated up to par, so that by maturity you got repaid face value. You earned $600 on the principal side as a result of buying the bond for $400. Are you with me so far? And getting repaid $1,000. Plus, what else is built into that YTM? The annual interest income that you earned every year. Case 2. Client goes out and buys a bond for $900. This is a $100 discount to par. The bond's got a 10% nominal yield or coupon rate built into the bond. The nominal yield is based on par value, not on the price of the bond. What's based upon the price of the bond? The current yield. Are you with me so far?
Yes.
Bondholders' cost basis, current yield, price of the bond. And this bond has got a 10-year maturity. So if the client holds this bond for the full 10 years, look at the yield to maturity in this bond. It's 11.72% YTM. Why is the YTM of this discounted bond so high? Here he's still earning a 10% nominal yield coupon rate. He's still going to get 10 $100 interest income payments because the nominal yield is based upon face value. But something else happened to this YTM here. Something happened on the principal side that did not happen with the par bond purchase. He earned $100 in that discount when he got repaid face value of $1,000 at maturity of a bond that he bought for $900. Therefore, the YTM shoots up in your overall return that reflects the appreciation of that discount that you earned over the life of that bond. What was that discount? The discount was $100. That $100 has to be accreted. The word accrete means to increase. So that the bond increases up in value. The word value means price, so that by year 10, the client gets repaid face value. Therefore, the formula for accretion, are you with me so far?
Yes.
Look up. Is to take this discount that this client's going to earn as a result of buying this bond for $900 and getting repaid face value. He's going to earn that discount over how many years? Over the 10-year maturity, am I right?
Yes.
That means the bond goes up in value or in price each year by $10 per year. Are you with me so far? So that by year 10, he realizes and receives face value. Therefore, by understanding the formula for appreciation, which is to increase upward in value or accretion, are you with me so far? You'll always be able to find the adjusted cost basis of how much that bond is worth in any one particular tax year. Example. The original cost basis of that bond is how much? $900. I ask you at the end of year 7 of a bond with a 10-year maturity, what is the adjusted cost basis of how much that bond is worth at the end of year 7? You're increasing upward the value of the bond, the price of the bond by $10 per year, so that by year 10 you realize and the client gets repaid face value. Therefore, $10 per year for 7 years means that the adjusted cost basis of the bond is worth $970. Am I right?
Yes.
$10 per year. And so therefore, the YTM of the discounted bond reflects the discount that's appreciated up to par plus the annual interest income, which is why the YTM of a discounted bond is the highest yield of all. You with me so far?
Yes.
Like the YTM of a discount bond is the highest return. Are you with me so far?
Yes.
The YTM of a premium bond is the lowest yield of all. Why? Or the lowest overall YTM. Because the higher the price you spend for that bond today, $2,000. Why did you do that? Because that bond has a higher coupon rate built into it, and you're willing to spend more money today to earn more money in interest income. You know that you're only going to get repaid face value at maturity. That bond built into the YTM, that premium bond, has to reflect the loss of that $1,000 over the life of that bond's 10 years. Am I right?
Yes.
Premium bond 7 amortized down to par. To amortize is to write off that premium each year equally, so that by year 10 you realize and get repaid face value. If that is the case, then let's take a look at case 3. Look carefully today. This bond costs $1,100. Are you with me so far? This bond has a 10% nominal yield or coupon rate. That's $100 a year in annual interest income. Are you with me so far?
Yes.
Look at the yield to maturity over this 10-year period of time by year 10. Look at the yield to maturity of this bond. It's 8.50 YTM. Why is the YTM of the premium bond so low? It reflects the loss of this premium that you're spending today, which is $100 over face value. That premium, which is this $100 that has to be amortized over the life of the bonds, 10 years, means that amortization is minus $10 per year. Are you with me so far?
Yes.
That would be the formula for amortization, so that by year 10, your client gets repaid face value. You have to write off this premium that you're spending today of the $100 over face value equally over the 10-year period of time, so that by year 10, your client gets repaid face value. Therefore, by understanding that you're reducing down the value of the price of the bond by $10 per year so that by year 10 you realize and get repaid face value, you'll always be able to find the client's adjusted cost basis of how much this premium bond is worth in any particular tax year. For example, if the original cost basis is $1,100 and amortization is minus $10 per year, what would the adjusted cost basis of the bond be at the end of year 6? Well, the original cost basis is $1,100. Amortization is minus $10 per year over 6 years is minus $60. Can you give me the adjusted cost basis of the value of the bond at the end of year 6?
1040.
1040.
1047.
No, 1040. Right. Now, what happens if at the end of year 6, listen to me carefully today, your client says, listen, I'm tapped out, I need liquidity. You know what? I can't hold this bond for its remaining 4 years until it matures. Are you with me so far?
Yes.
And at the end of year 6, he puts in a sell order with you, breaks the bond's maturity, and asks you to sell that bond out there in the secondary market for liquidity needs. And you capture a sale price of $1,070. What was generated? What was done? What was transacted? You sold the capital asset and captured a sale price that was higher than its adjusted cost basis at the end of year 6. What's that known as? That's a capital gain of how much? $30 on that bond transaction. Are you with me so far? So whenever you break a bond's maturity for liquidity needs, because your client might not be able to hold the bond till the full maturity, and sell that bond, which is a capital asset, out there in the secondary market, you will generate potential capital gains or capital losses if you capture a sale price that's higher or lower than the adjusted cost basis any particular tax year. So that's not a capital loss. The adjusted value of how much the bond is worth at the end of year 6 is $1,040. You sold it for $1,070. So we understand that there's no calculation here on NASDAQ on this particular concept, but we have to understand that discount bonds appreciate or accrete up to par, premium bonds amortize down to par, and that means that we have to understand the concept of appreciation, accretion, and amortization. Are you with me so far? Yes. So that by maturity, the client gets repaid face value. Whether we have to increase up the value of the bond each year, that discount that we're earning, until maturity, or whether we have to write off that premium down each year so that by maturity we get and realize face value payable to the bondholder. And so we see that the yield to maturity and the yield to maturity analysis reflects case 1, principal break even plus interest income every year for 10 years. Discount depreciation plus interest income every year for 10 years. Premium amortization plus interest income every year for 10 years. All built into the yield of maturity, which is the client's overall percentage return on his bond investment. Every bond you buy has 3 yields built into the bond. Every bond you buy has a nominal yield, a current yield, a yield of maturity. And they are completely different from one another. Nominal yield, a coupon rate, annual interest income. Are you with me so far? Yes. Based on a tied to face value. Current yield, return currently on the cost basis only for the capital investment today. And the yield to maturity, the client's overall percentage return on his investment. 3 different yields built into every bond. Are you with me?
Yes.
Bonds can be priced. Now a little bit about pricing. At any one of 3 prices. Are you with me so far?
Yes.
Buy it and trade it at a premium, any price above face. Buy it and trade it and purchase it at face, $1,000. Buy it and purchase it and trade it at any price less than face, discounted bonds. Are you with me so far?
Yes.
Let's talk a little bit more about bond pricing. Are you with me so far?
Yes.
I ask you to look out there in the marketplace today and ask you for a quote on a bond. Broker looks out there in the bond markets and he says, Mr. Johnson, this bond's quote right now is trading right now in the market at 90. 90? Now, we're going to take that quote, watch carefully, and tie it to par value. Again, here we go with par. Par is now becoming a benchmark that we use from which to price certain bonds. Now, I want you to take that quote that you said was 90 in the market and transfer that quote to become a percentage of face value. So 90 means 90% now of par. I took the quote of the bond that you told me was trading out there in the bond market at 90. And I made 90 become 90% of face value. Are you with me so far?
Yes.
Take the quote of the bond and make that bond quote become a percentage of face. And 90 means 90% of par. You're using par value and you're taking the quote on the bond to become a percentage of face value. And so what does 90% of $1,000 mean? 900 what? I'm sorry, I need you to talk to me today. And pick another 2 days not to respond. Don't pick these two. What does 90% of $1,000 mean? 900 what? Dollars. You just said the word dollars. These bonds are called dollar bonds. Dollar bonds are priced and verbalized in terms of a dollar price. How did you have that bond become priced in terms of a dollar expression? You took the quote on the bond and you transferred that quote to become a percentage of face. When you take any bond and its quote and transfer that quote to become a percentage of face value, you have what are known as a dollar quote. These are called dollar bonds. Are you with me so far? Yes. So 90 means what? $900. Are you with me? Yes. Okay, that was when the bond markets were open. Now I called you back and I said, my broker, you remember you told me today at 12:47 p.m. that that bond was trading at $90 or $900? Yeah. Where did it close in the bond market, that bond? On 91. 91 what? 91% of $1,000 means $910. Are you with me so far? Yes. How many percentage points did this bond close up in the bond market today? 1%, which represents how many dollars in price fluctuation? A 1% movement in the bond, are you with me so far, yes, represents Series 7 a $10 price fluctuation. If bonds close down 1%, bonds close down $10 in price in the market. Bonds closed up 1%, bonds closed up $10 in price in the market. I'm talking bond pricing now. A 1% movement means a $10 price fluctuation. Are you with me so far? Yes. So, if you want to know how many dollars the bond moves in the market, are you with me so far? Yes. What do you have to know as a prerequisite? How many percentage points it moves. Because if it moves up or down 1%, are you with me so far? Yes. It moved up or down in price, in dollars, $10. Are you with me so far? Yes. But what if you wanted to know how many percentage points the bond moves in the market? Well, then what do you have to know as a prerequisite? How many basis points it moves. Now, the basis point language that I'm about to use associated with bond pricing is the same language that we use concerning basis points with respect to the Federal Reserve and monetary policy and the movement of short-term interest rates. Any movement in the market, please listen to me very carefully. Here's your benchmark. Whether it's in the Federal Reserve money markets or in the bond markets, is that moves 100 basis points means a 1% movement. Are you with me so far? Yes. Now, a 100 basis point movement in the bonds in the market, are you with me so far, yes, means that bonds moved 1%. And what does a 1% movement represent in price fluctuation? $10. So there's your benchmark. Are you with me so far? Yes. Per bond. Watch this. Bonds closed down in the bond markets today 25 basis points. Bonds closed down 1/4%. Bonds closed down in price $2.50 per bond. Bonds closed up 75 basis points in the bond markets today. Bonds closed up 0.75% per bond. Bonds closed up $7.50 per bond in price fluctuation in the market. Bonds closed down 50 basis points today in the bond markets. Bonds closed down 0.5%. Bonds closed down $5 per bond. Are you with me so far? Yes. So if you want to know how many percentage points the bond moves, what do you have to know? How many basis points it moves. Once you know how many percentage points it moves, you know how many dollars it moves, and the benchmark is, I'll say this one more time, a 100 basis point movement represents a 1% movement, which represents a $10 price fluctuation in the bond markets with respect to bond pricing. That's a little bit about pricing. That's a little bit about the 3 different yields that are built into every bond. Are you with me so far? Yes. Bonds can be priced at premium, par, or discount, and bonds can only experience 1 or 2 maturities. They can be known as short-term bonds. These are any bonds with a maturity 7 of 10 years or less. Long-term bonds, 7. These are any bonds with a maturity of 10 years or greater. So, I want you to look up now because we got to take a pause. You got to listen to me real careful at the fundamental concepts associated with all bonds. And here they are. And I want you to forget this. Watch this. The fundamental concepts associated with bond pricing and bond yields and bond maturities represent the following. 3, 3, 2. 3, 3, 2. There's the pass rush to NASDAQ. And I'm sacking the 7. Oh, yeah. Bonds have any one of 3 prices. 3, premium, discount, and par. Every bond you buy has 3 yields built into the bond. Are you with me so far? Yes. Nominal, current, yield, and maturity. And bonds can only experience 1 or 2 maturities. Long-term or short-term bonds. With a benchmark that distinguishes long-term between short-term as 10 years or less or 10 years or greater. Are you with me so far? Yes. 3, 3, 2. Now, in your examinations and your chapter exams, and some of the ROM work that you're going to be going and completing and working with going forward in phase 2 in the schedule that you're going to get on Monday, or so far, you're going to see a lot of questions associated with bond computation, associated with bond pricing and bond conversion and bond parity and bond yields. Are you with me so far?
Yes.
Not on the actual Series 7 exam. Look, I don't know if you understand what I'm communicating to you, but if I were you, I would listen to me very carefully when I give you perspective, because I'm here to tell you something, and I'm not modest about it. There isn't anybody on the planet that knows that exam the way I know it for 20 years of my life. I'm telling you something that's more powerful than you think. And despite the transactional computation that you'll see in a lot of the chapter exams and the work that I give you, on NASDAQ there isn't any question, not one, concerning bond calculations regarding bond pricing or bond yields. Well, if the question on the Series 7 exam is not one of computation, are you with me so far mathematically, then it can only be one other type of question. It's got to be regulation. Are you with me so far? I got 125 regs at minimum, 140 at maximum. You're going to get it over 2 days, and I'm starting right now. So, listen to me carefully. These regulations are the most devastating on NASDAQ. Why? Because there is a significant Roman numeral format, 1 only, 2 and 4, none, all, 1, 3, 4, distortion associated with their level of ambiguity. And when you place transactional questions that are regulatory in that type of distorted format, and you lay down on top of that type of distorted format a minimum 125 to a maximum 140 regulations, you deal with the most devastating questions on NASDAQ. And that's why the bond area is so significantly problematic. Are you with me so far? But don't worry. You know why? Because you got me. And you want to know what that means? I'll tell you what it means in case you don't know it. I know where every regulation lies. And I'm going to give it to you over 2 days. All you have to do is receive it. Do you think you can do that?
Yes.
I'm hoping so. So why don't we start right now with what NASDAQ seeks. If there's questions only on regulation and not on calculation associated with 3 fundamental concepts, are you with me so far?
Yes.
Well, then what does NASDAQ want associated with these bond prices and these bond yields and these maturities conceptually, regulatorily? I'll tell you exactly what they want right now. They want a concept known as interpolation. Now, I need you to listen to me today. You have to listen to me at a higher level. You've been with me now for, this is 3 weeks. You should be able to know that when I speak to you, I speak very exacting. And I didn't say interpretation. I said concerning these prices and these yields and these maturities of 332 and these fundamental concepts, NASDAQ seeks regulation associated with the concept of interpolation. Now, before I trade interpolation with you, like I'll trade everything else with you, I think we need to establish the definition of interpolation first. Are you with me so far?
Yes.
So look carefully. Interpolation is the interrelationship among these yields. So right there you can have a problem with what that means. It means how these yields relate to one another. The interrelationship between the current yield, the yield of maturity, and the nominal yield. How they relate to one another. Based upon, look up, buying the bond at 3 different values. Still don't understand the definition of interpolation? Let me be even more fundamentally blunt. If your client goes out and buys a bond and purchases it at face value. Right, thank you. Or maybe he goes out and buys a bond at a discount to face, discounted bond. Or maybe he goes out and buys a bond, and he will in a moment, at a premium price. What are these yields, and how do they relate to one another? Are they equal to one another, less than one another, or greater than one another? The interrelationship, listen carefully, among these yields, how they relate to one another based upon buying the bond at any one of 3 different valuations, is the concept of interpolation that we need to sum up for NASDAQ. And if you'll allow me, I'm going to trade interpolation with you conceptually right now. Are you with me?
Yes.
It just requires that what we've covered so far concerning the definitions of these yields and a little bit about bond pricing, you got it under your belt. Are you with me so far?
Yes.
You think you're ready to trade with me?
Yes.
Yes? Yes? I want you to put your pens down because I'm going to trade with you right now. Watch this trade. Look up carefully. Client calls up and he says, I got $250,000 to go. I don't want any capital risk. I want protection of the principal. I want guaranteed interest income. I'm looking fixed income. What do you got? I got a $1,000 par bond purchase, Mr. Johnson, with a 10% coupon rate built into that bond. Lock your money up for the full 10 years. You're not going to see 10% for a long time. And you'll earn an overall 10% on your money. 10% on my money. Wow. Take a look at the maturity in this bond. 10 years. What's the nominal yield on the bond? 10%. It's $1,000 per bond, and wants to give you $250,000 to go to bury it into this bond portfolio, and he's going to lock his money up and hold it up for the full 10 years. The maturity of the bond, are you with me so far?
Yes.
Is based upon, in your recommendation to clients, which way you believe the Federal Reserve will move interest rates into the future. So the expectation here is that's a very attractive rate. Rates that we really are not very common out there in the market. Are you with me so far?
Yes.
And we don't think that rates over the next 5 or 7 years are going anywhere near that. Are you with me so far?
Yes.
So that's why you're recommending the client lock his money into a long-term maturity to lock in at the highest coupon rate you can find in the secondary market regarding this particular bond investment. Why, if you believe that the Federal Reserve will raise rates, are you with me so far?
Yes.
You would recommend, if the client is looking to invest in a bond portfolio today, a short-term bond portfolio investment of 2, 3, or 4 years, so that after that short-term bond matures, he then can reinvest that money into new bonds at higher interest rates. So the rate recommendation is tied to the maturity of the bond and which way you believe the Fed will move interest rates, because remember, that same movement of interest rates by the Federal Reserve represents the nominal yields on new bonds. Are you with me so far?
Yes.
Because the interest rate is a double-edged sword. When the Fed goes contractual, are you with me so far, and they're raising rates, that means that new bonds are being offered out there at higher nominal yields. Are you with me so far?
Yes.
Okay, so client locks in. This is case 1 for the concept interpolation, buying the bond at face value. Let's take a look at these yields. I'm going to move my body over here a little bit so you can see. Now, here's your product. Are you with me so far?
Yes.
You just invested $250,000 to go. What's the nominal yield on that bond? Can you tell me? 10%. So let's plug it in, 10%. Now, let's take a look, excuse me, at what the client's investment returns would be on a $1,000 cost basis. That's known as the current yield. The current yield is the return on the $1,000 capital. Am I right?
Yes.
Are you with me?
Yes.
Now, that's calculated by taking the annual interest income. This is the formula for the current return on the $1,000 cost basis. And what is the annual interest income here? Well, that's the nominal yield times face, which is how much?
$100.
And what is this cost basis here?
$1,000.
So this yield would give you the return on a $1,000 cost basis investment today, and for today only currently. And therefore, what's $100 divided by $1,000? It's 10%. Are you with me so far?
Yes.
And if the client holds this bond for the full 10 years, which is case 1, are you with me so far?
Yes.
What is the client's overall yield to maturity on his investment?
10%.
I can't hear you.
10%.
10%. Now I'm going to sing a song for you. Oh, I'm singing a song. You have no idea how desperate I am for you to pass this exam. As desperate as you are. Now, the song I'm going to sing for you is a song I never want you to forget. And I'm going to make you a promise. And I'm not the first person to say this. When you get into NASDAQ and you're at 40 Rector and you're taking this examination, this question comes up and questions like this on interpolation, I promise you, you're going to see my face come through the screen and you're going to hear my voice, because that song is going to be right there in the test center, because I'm going to sing it for you right there. You're going to see it, you're going to hear it, you're going to hear my voice. But I never want you to forget this song. Are you with me so far?
Yes.
When the client goes out and buys a bond at face value, for the concept 1 of interpolation, of buying the bond at face, the nominal yield is equal to the current yield is equal to the YTM. The nominal yield is equal to the current yield, which is equal to the YTM. The nominal yield is equal to the current yield is equal to the YTM. All these yields will always be equal to and among one another when buying the bond at par. Set! All yields equal to. Are you with me?
Yes.
Are you with me?
Yes.
Like my song? Well, if you like that song, wait until you see the second song I'm going to sing for you, because I got a few songs for you today. Now, so the client locks in and buys the bond. Are you with me so far? He's real happy. And guess what happened? In a different world than the world we're living in right now, the Fed decides to go rate rise. Are you with me?
Yes.
New bonds come out at higher nominal yields. New bonds come out at 11.72% nominal yields. Your client who locked into the original bond was just subject to what risk and by what percent? Series 7, interest rate risk. What is interest rate risk? Series 7, bullet 1. It is the risk, look up, that if new bonds come out at higher nominal yields, your existing client who bought into the original bond is losing the opportunity to earn what? 1.72% more money in interest income. Are you with me so far?
Yes.
Listen to me. This is the most important yield. Are you with me so far?
Yes.
I know that differential, 1.72% for new bonds versus old bonds, doesn't sound significant to you. On a $250,000 or a $750,000 bond portfolio, and that's per bond, that represents staggering interest income differential. Are you with me so far?
Yes.
The old bond is paying a fixed 10%. Are you with me so far?
Yes.
New bonds are being offered out there in the marketplace at 11.72%. Are you with me so far?
Yes.
So, client B calls up Mr. Johnson, and he's got $1.5 million to go. You'll find these significant investments are easier invested in bonds and more likely than they are in the potential equity positions. Are you with me so far? Because we're dealing with a certain level of protection of principal. Are you with me?
Yes.
And that guaranteed interest income. Are you with me so far?
Yes.
Well, when Mr. Johnson calls up with a $1.5 million capital investment, he wants fixed income, he might ask you what's out there in the marketplace. We still have in the marketplace the original bond that's paying 10%. You with me so far, nominal yields. But Mr. Johnson, we have new bonds that are being offered out there in the marketplace at 11.72% as a result of the rate rise by the Fed. Which bond investment do you think this client's going to want? You always want to earn the highest return that you possibly can in your investment. And as far as bonds are concerned, you want to earn the most amount of money you can in interest income. You with me so far?
Yes. And
therefore, this client's going to want this bond. And Mr. Johnson, I totally agree. Why earn 10%? We can earn 11.72% interest on our money. Are you with me so far?
Yes.
But Mr. Johnson, for that higher interest income, are you with me so far? Yes. That bond's going to cost you a premium price. Pay more to earn more. Are you with me so far?
Yes.
This bond is going to cost a $100 premium over face. This bond is going to be priced at $1,100. Most investors are willing to spend that $100 premium today to earn more money in interest income today, knowing that their overall return will be much lower in the form of the yield to maturity as a result of the premium that has to be amortized down to par. Are you with me so far?
Yes.
When this is the whole game, interest income. And so we clearly see what's exciting about this investment. Are you with me so far?
Yes.
That also represents a problem associated with the original bond. 10% cannot compete with 11.72%. I'm sorry, no way, no how. Are you with me so far?
Yes.
Can't lie about the percentages. Not many people are going to want this bond. Why would you want to buy a bond and earn 10% when you can spend a little bit more money today to earn more money in interest income? Well, the whole game associated with fixed income is all about interest income. Are you with me so far?
Yes.
No, I'm sorry. The old bond just cannot compete with the new. 10% cannot compete with 11.72%. Agreed.
Agreed.
But the secondary market wants to create competitiveness and excitement for the old bond. They want to stimulate marketability for the old bond. They want to stimulate investments for the old bond. You with me so far?
Yes.
Well, I'm sorry. Nobody wants to bond at 10% when we can spend a little bit more money to earn 11.72% on our money. No, the nominal yields, the coupon rates are non-competitive. Are you with me so far? But what do you think, excuse me, the secondary market will do to the old bond, trading out there in the secondary market, to make it competitive with the new? Well, somewhere, the secondary market, if you'll allow me for a moment here, is going to try to do something to the old bond here that allows the old bond to have a higher return to compete with the new bond. Are you with me so far?
Yes.
Can't change its coupon rate. That's fixed. But what the secondary market will do is will change the price of the old bond. They'll slash it. Are you with me so far?
Yes.
By slashing the price of this old bond that was originally priced and traded at par, are you with me so far,
Yes.
to now trade at a discount, are you with me so far?
Yes.
Well, it didn't affect the nominal yield. That's still 10%. But by slashing the price, look at the yield to maturity of the old bond. It's no longer 10% anymore. Why did it soar up to 11.72%? Because when you buy this bond at 900 now, are you with me so far, in the secondary market, still earning 10% on your money, are you with me so far?
Yes.
The yield to maturity goes up to 11.72% because this bond now will appreciate as a result of the discount that will be earned by now having it priced at a discount from par. The yield to maturity increases now because of the appreciation of that discount, which is that $100, that will now have the YTM of the old bond change from 10% to now be 11.72%, which, by the way, is exactly equal to the nominal yields on new bonds. What I have established for you is parity on these two bonds. Watch this. Pay more money today for the new bond to earn more money in interest income, willing to take on a lower overall return on your investment in the form of a lower yield to maturity as a result of the premium that has to be amortized down to par, or pay less money today for the old bond, earn less money in interest income, but have a higher overall return at maturity through the appreciation of that discount. These two bonds are exactly at parity. Are you with me so far?
Yes.
And that's what the secondary market has created, competitiveness for the new bond with the old bond by slashing its price. So what happened? That when interest rates rose, are you with me so far?
Yes.
What happened to the price of the old bond?
Down.
So when interest rates or the nominal yields on new bonds go up, are you with me so far? What happens to the price of the old bond? I'll say it again, look up. I'll say it again, look up. What happens?
Goes
So what relationship do you see exists between the price of the old bond and the nominal yields on new bonds? Series 7, price and yield will always move inverse to allow the bond markets and bonds to become competitive. Are you with me so far? The price of the old bond will go down if nominal yields go up. If nominal yields go down on new bonds to 7 3/4, are you with me so far, as a result of an expansionary policy by the Fed? Look at the yield on the old bond. It's 10%. You're going to want that. You're going to pay more for it. It's going to go up. Price of bonds trading out there in the marketplace relative to the movement on interest rates on new bonds and the nominal yields will always move 7 inverse. Are you with me so far?
Yes.
Okay. So here's your bond now. I've changed the price of your bond. Are you with me so far? It was par. Probably got 9 years left remaining to its original 10 maturity. This price reduction probably happened after year 1. Are you with me so far?
Yes.
It's now priced at 900, still at 10%, 9 years left remaining to its original 10-year maturity, and now the yield of maturity is 11.72% as a result of the appreciation of this bond now, as a result of its price at a discount. Let's take a look at the concept for interpolation. Concept 2, buying the bond now at a discount, and how these yields relate to one another. The nominal yield will always be 10%, regardless of the price fluctuations of this bond. Are you with me so far?
Yes.
Because what do you know about the nominal yield? It is fixed. Are you with me so far?
Yes.
But let's take a look now at the current yield on the bond. Annual interest income, it's based upon the coupon rate times face. The nominal yield is based upon the interest income received is based upon par. The price of the bond will determine the current yield. Are you with me so far?
Yes.
And so therefore now, it's $100 still in annual interest income. But what's your cost basis now?
900.
Okay. Is your cost basis less? Say yes.
Yes.
Well, then your return on capital will be higher, because the current yield reflects the return on capital. If the capital investment is lower because you're buying the bond at a discount, then your return on capital is higher. Why is the current yield 1.1% higher than the nominal yield for a discounted bond? What does the current yield reflect that the nominal yield does not, that makes the current yield 1.1% higher than the nominal? The cheaper the cost basis, the higher the return on capital, the discount price. Are you with me so far?
Yes.
What yield will be the highest yield of all?
Yield to maturity.
What is the yield of maturity of this bond? 11.72%. What does the yield to maturity reflect that the current yield does not, that makes the yield of maturity higher than the current yield when buying the bond at a discount? That's when you're going to actually earn that discount. Are you with me so far? If the current yield reflects the cheaper cost basis, which means the higher the return on capital, are you with me so far? Then the yield of maturity has got to be the highest of all, because that's when you're actually going to earn that $100 when you got repaid face value of $1,000 at maturity of a bond and you bought it $900 and you're actually receiving that discount. Are you with me so far? The discount paid, current yield, discount earned. Are you with me so far?
Yes.
And so the song for the concept of interpolation has finally changed now and gets adjusted. And so that when buying the bond at a discount, the nominal yield is less than the current yield, is less than the Ytm 7. The nominal yield is less than the current yield, is less than the Ytm 7. All yields will always be less than and among one another when buying the bond at a discount. Are you with me?
Yes.
I'm cutting you off because they can hear you, and I don't want them to. I want them to hear me. Thank you. So, I've got to tell you what happened, though. There has been a change in the market. Please look up. New bonds now come out. Watch this. Watch this. At 7 3/4 nominal yield. This bond's probably going to be priced at $8.50. Pay less to earn less. Are you with me so far?
Yes.
Look at the old bond. Doesn't that 10% now for that existing bond in the marketplace look very attractive compared to new bonds at lower nominal yields? If new bonds come out at lower nominal yields, are you with me so far? What's going to happen to the price of the old bond? You're going to spend more money for this bond. Are you with me so far?
Yes.
Because it's much more attractive at 10% than the nominal yields of new bonds. Price and yield are inverse. Are you with me so far? Are you with me so far?
Yes.
I need you right here. So, the nominal yield is still 10%. But now let's take a look at the current yield. What's your cost basis now? $1,100. Are you spending more money in capital? Say yes.
Yes.
Why would you do that? Because the existing nominal yield for the old bond is much higher than the nominal yields on new bonds. With me so far?
Yes.
Higher cost basis. Look at this. Lower return on capital. Are you with me so far?
Yes.
What yield will be the lowest of all? Why? Because the yield of maturity reflects the loss of that premium that you're spending today. Are you with me so far?
Yes.
And the song has finally changed and the music has ended. Are you with me so far?
Yes.
In that, for the concept 3 of buying the bond for interpolation at a premium price, The nominal yield is greater than the current yield, which is greater than the YTM. The nominal yield is greater than the current yield, which is greater than the YTM. Are you with me so far?
Yes.
All yields are greater than and among one another when buying the bond at a premium, less than and among one another when buying the bond at a discount. All bonds yields will always be equal to and among one another when buying the bond at face value. And so understanding those concepts and the movement of which way bond prices move in the marketplace reflect the relationship between those yields, and that is the concept interpolation of what they seek without calculation on NASDAQ. Question, sir?
The yields would be less than...
Oh, I could sing it to you again if you like. Well, okay, you don't want me to sing again? I'm not a good singer? All right. When you buy a bond at par, didn't we see mathematically that all those yields are equal to one another? Always start out with the nominal and with the YTM. Nominal is equal to the current, which is equal to the YTM. And all less than and among one another when buying the bond at a discount, and all greater than and among one another when buying the bond at a premium. That was what was on 511 that we said, which is right there for you, so you didn't really even have to write it.
Tony,
Yes.
Is the YTM, is the interest...
Excuse me, I can't hear him. Yes, sir. Excuse me, I'll be right with you.
Is the interest that you make in the YTM...
It's built into that YTM. It's reflecting what's happening every year. The YTM is reflecting what's going on the interest income side and what's going on the principal side. So I'll say it again. On the YTM, for case 1, what's built into that 10% of buying a bond at $1,000 with a 10% nominal yield? It reflects the break-even of principal, paid par, we got repaid par, plus 10 $100 interest income payments. What about the YTM of a discounted bond? The appreciation of the $100 plus 10 years of $100 a year, and the loss or the amortization of that $100 for a premium bond plus the interest income every year. The entire return and all what's going on in the principal on the interest side is being reflected and built into the YTM, the entire return to the bondholder reflected in that overall percentage return, YTM. Well, we take a look at the second concept here. Look up. First was price versus yield on bonds in the marketplace, and we said that that was inverse. Am I right? To make them competitive, am I right? What about the yield? When I don't qualify what yield out of the 3, I'm only talking about that one. Are you with me so far? If we say, what's the yield on the bond? We're not talking about the current yield and the yield of maturity. We always talk about the interest income that that bond pays. What's the yield that that bond is paying? We're talking nominal yield. Are you with me so far? Well, the nominal yield of a bond relative to the bond's maturity. This concept is a little bit different. It draws the comparison between the distinguishing factors that determine whether one bond pays 4% and another bond pays 9%. And I think you can see that that factor here is the maturity of the bond. If, Gio, you said you're willing to lock your money up by fixed income with a $500,000 investment for long-term 20 years and bury this into your IRA, well, then you're probably going to earn a good 11 or 12% on your bond investment. If, Mike, you said to me you're only willing to invest $250,000 today and short-term in nature with respect to maturities, 3 years, we have a new president, we have uncertainty with respect to the economic landscape, and you'd like to see where it's going to be going, and so you want to keep relatively liquid, well, then you're only going to earn 4%. Now, you're both taking on a certain level of interest rate and inflationary risk. Am I right?
Yes.
And because if it was a 10% coupon rate, 10%, $100 today is not going to be worth $100 5, 7, or 10 years from today. Am I right?
Yes.
It's just that, Gio, you took on a higher level of interest rate and inflationary risk than Mike did over the longer the maturity of 20 years versus 3 years because even though you both experience a certain level of interest rate and inflationary risk, over the longer the maturity of the bond, those bondholders who lock in long-term versus short-term bondholder investments are experiencing a much higher level of interest rate and inflationary risk than over short-term bond investments, and therefore we're going to have to pay those long-term bondholders a higher nominal yield to offset that higher level of interest rate and inflationary risk. Concept 2. Higher nominal yields for bonds with a longer maturity than bonds with a shorter maturity, paying those long-term investors for that higher level of interest rate and inflationary risk than bondholders who lock their money up over a shorter period of time. Are you with me so far?
Yes.
Look at me. Look at the third concept. The price fluctuation of a bond in the market, moving up or down in price, relative to its maturity. Look up. How many times did this bond's price fluctuate in trading in this room? 2 or 3?
3.
That's one answer. There's 20 of you here. You have to trade with me. Otherwise, we're not going forward. How many times did that bond's price fluctuate? 2 or 3?
3.
The answer is 2. The original pricing of this bond, look up, was face. That was not a price fluctuation. Price fluctuation 1. New bonds came out at a higher nominal yield and a rate rise by the Fed. The bond went down from par to a discount. And finally, price fluctuation 2. New bonds came out at lower nominal yields of 7 3/4, and the bond went from a discount to premium. Are you with me so far?
Yes.
Now watch this. I'm talking this concept right here. The price fluctuation of any bond in the marketplace over the life of its maturity. Are you with me?
Yes.
I'm going to draw 2 bonds for you. One bond has a 5-year maturity. Another bond has a 20-year maturity. What do you know about the price fluctuation of any bond? Which way will it move? Inversely, to the nominal yields on new bonds. Am I right?
Yes.
Any bond's price will move inversely to the nominal yields and the movement of interest rates on new bonds. Am I right?
Yes.
Look at what happened to bond A. After 5 years, the bond has matured. Its price fluctuations cease. How many more years does bond B's price fluctuation have to bond A? 15 more years. So what do you know about the longer the maturity of the bond? The greater the price fluctuation, the bonds with shorter maturities, simply because it has a longer period of time to move inversely to the nominal yields on new bonds. The probability, I'll put it to you another way, the probability that interest rates will come out higher and lower more often than the rate of that bond is greater over a longer period of time than over a shorter period of time. Therefore, bonds that have longer maturities and shorter maturities experience Series 7 greater price volatility and price fluctuations than bonds with shorter maturities. But we all know that any bond's price will always fluctuate inversely to the nominal yields of new bonds. It's just that over the longer the period of time, it will experience greater volatility and greater price fluctuation because over 20 years, the probability that interest rates will come out higher and lower more often is greater than over a 3-year period of time, simply because it has a longer period of time to move inversely in price fluctuation to those interest rates. Are you with me so far?
Yes.
3 concepts. Fundamentals. Are you with me so far?
Yes.
And now we've talked about interest rate risk. We've talked a little bit about inflationary risk. But there's another risk that we have to wrap up, and that is credit risk. Look at me. Listen to me this week. How would you like to earn 16% nominal yield on your bonds? Say yes. About 11%. Exciting. I mean, 9 3/4 is fabulous. Are you with me so far?
Yes.
How about 14%? Show me where. I'll show you where right now. Here's what you're going to have to invest in order to earn those yields. I want you to take your capital and go out and buy Nicaraguan bonds, buy Zairean bonds, buy Ivory Coast bonds, buy Mexican bonds, buy Medellin, Yankee, Colombian bonds. You want to buy Argentinian bonds right now? You're going to have great yields, and inflation is more than 346%. So, when you go to underdeveloping worlds, third world issuers, are you even so far?
Yes.
Iraqi bonds, Middle Eastern bonds. There's a lot of political, economic instability in those countries. Are you with me so far?
Yes.
Mexico. I love this one because if you go on the internet and you read Noriega's testimony, you remember this guy who was in jail, he's probably out of jail right now, who ran the government through the military. Are you with me so far?
Yes.
Noriega has shown proof in his testimony that when you go to Cancun and you're lying there with your girl and your guy and you're having lobster and cracked crab and you can't make up your mind whether you want to have breakfast or you want to just go for another swim, and you're lying under a hut and a guy named Jorge is coming and serving you Coco Locos at 11 o'clock in the morning, walking on blistering sand, and he doesn't feel a sweat. What should we have today, Jorge? I don't know. What do you think? Have another Coco Loco and think about it. This is vacation. That entire resort, Cancun, was financed with drug money through the Noriega administration. Unbelievable. It's true. Heroin money. Incredible. Pink sand and all. Mexico is so fiscally broke, they barely have enough money to implement a toll without subsidized foreign money infused into the country. They rely their country on tourism. Are you with me so far? So you look at these countries, Nicaraguan bonds, Congolese bonds, Zairean bonds. Let me ask you a question. You buy a Nicaraguan bond with a 25-year bond maturity. What do you think the probability is that exists that over the life of that 25 years, that government might implement a couple of coup d'etats and might not even be there to pay you your interest over the life of that 25 years? I mean, it's pretty great. Am I right? Yeah. You want to buy a government bond or a government security? Hey, 3.43% for a 10-year govie. I know, I own them. They're not going out of business, and there's no potential default, but the yields on those bonds are not great. And so therefore, we look at what is called credit risk. And that is the risk that the issuer has a high probability of the potential default and repayment of debt service to those bondholders. I use this language because I want you to get with this language. What is debt service? The repaying back to bondholders by the issuer of interest and principal built into the bond. The higher the credit risk, the higher the nominal yield. Am I right?
Yes.
The higher the probability of the potential default that you might not get your interest and principal, those bonds have staggering yields. Are you with me?
Yes.
Therefore, we have two companies that are down here on Wall Street which are legendary and iconic. They are Standard & Poor's and Moody's. These two companies rate the credit risk of issuers. They rate the probability of issuer potential default in the repayment of debt service to bondholders. Are you with me so far?
Yes.
The higher the credit risk, the higher the nominal yield. And the rating, if you'll go to that chart, are you with me so far,
Yes.
is alphabetical, where lowercase stands for non-capital letters and uppercase stands for capital letters. Are you with me so far?
Yes.
And now I'm going to ask you a question associated with NASDAQ. But I need you to look at your chart while I ask you the question. Are you with me so far?
Yes.
This is 7. This is Series 7. Are you there?
Yes.
Look at your chart very carefully when I ask you this question. According to the credit rating services of Standard & Poor's and Moody's, provide by alphabetical credit rating breakdown the most speculative within the investment grade. Now, let's take Jack, and you might respond for S&P, and let's take Priscilla for Moody's. Who's going first? Jack? Can I have S&P? I'm sorry, Mike? Okay, there's no Jack. What do I know?
Capital D, C, C, C.
Excuse me. Thank you, sir. You're reading me the whole chart. This would reflect, excuse me, thank you. This would reflect one response for one rating here. You're reading me the entire chart, which means you don't understand the question.